Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, welcome to We Build Great Apartment Communities. I am your host, John Brackett. I have another great guest, and this, of course, is going to be another amazing episode. His name is Travis Watts. And I appreciate everybody tuning in. This conversation is going to be an interesting one and a unique one because Travis and I, when we were first starting this discussion, he was talking to me about some kind of tribe that he's a part of in Hawaii, some kind of fire group. What is the fire group called, man?
Oh my God. What a way to set me up.
What is the fire group called again?
Yeah, John, we were talking about the FIRE movement. So financial independence, retire early. A bunch of us Hawaiians dancing around campfires, here in real estate, cash flow. It's kind of like that.
Oh, dude, that's a good one, man. That's a good one. All right, so we're going to get back to that acronym, but found that intriguing, right? Fortunately, I don't have any fire pits behind me, nor do I have any active volcanoes, but we're definitely going to get back to that. So, Travis, let me introduce you, okay? So, just so our audience has a better feel for who you are. So Travis is a full-time passive investor. He's been investing in real estate since 2009 in multifamily, single family, and vacation rentals. So we're going to talk a little bit about that and the transition. So Travis is also director of investor relations at Ashcroft Capital. He dedicates his time in education of others who are looking to be more hands-off in real estate. Okay, so this topic is going to be undoubtedly about passive investing, okay? Because that's where your background is, that's your world. So we're going to get into that. So why don't you start, man, by sharing your story, right? I mean, I know you dabbled in a couple different types of investments. You made a transition to multifamily. So talk to us a little bit about, your story, and just so that you have some context, right? So our audience, 40% operators, about 40% passive investors, and about 20% folks that are new looking to get into this business. We don't really know yet if they're looking to be operators or passive investors, and we can't really figure that out until we get more data. But that's what it looks like. So that's who you're speaking to. So Travis, welcome to the show, man. It is all yours. Give us your story, man, your background.
Awesome. Thank you so much, John. I'm super excited because, yes, today I am full-time passive. However, I certainly didn't start that way. I was an extreme full-time active real estate investor. So the journey really started in 2009. I bought a 2-bedroom, 1-bath condo. Actually, it was out in Colorado and in Fort Collins, for those familiar, about an hour outside of Denver. And, I didn't know what I didn't know. What I did know is I like the concept of real estate. I had heard about these tax advantages. I'd heard about cash flow. I'd heard about forcing equity. All these different things were so new to me. I was so green. But I just wanted to get started. I thought, that's just me as a person, as I'm a hands-on kind of guy. That's how I learn best. So I stepped into the space, as a lot of people do with kind of the single family home or the condo townhome. I did some house hacking. I rented a spare bedroom. I tried doing these fully furnished things. I was near a college campus.
I'm going to pause, okay? I got to ask you this. I mean, what in the world is house hacking? I keep hearing people say that. Of course, I have my own ideas. But you have to understand, if I line 10 people up in front of me and I ask each of them that question, the answer is always different. So what in the world is house hacking? From your perspective, at least.
Give you my interpretation. When I was doing it, I didn't know it was called that. And maybe it wasn't at that time. But now you get on Bigger Pockets and there's books on this. And I guess this is now the term. House hacking means basically you move into a home that you yourself live in and you rent either a spare bedroom or multiple spare bedrooms or a basement or a guest house. And that effectively pays for your cost of living in the home. So you're kind of hacking the system, so to speak, right? Living for free or close to it instead of having a big liability on your books and a big overhead and a payment due. So that's what it meant for me. That's what it was. To tell you the numbers, I had a mortgage of $640 and I had a roommate that paid me $600. So effectively $40 a month was what I paid to live just after college. So pretty enlightening for me. Kind of, I feel like that is what started to spur the idea of being a passive investor, truthfully, is that I realized I didn't make much money back then at all. I worked a horrible job, actually, in a call center. And just having someone hand you a check for $600 really had a profound impact on my life at that time, realizing I didn't have to work for that money, right? That was passive to me. So I got inspired with this idea that I
Hey,
really want to dive
Travis,
in.
what you said, I think I can relate to that. I can understand that, right? So
Yeah.
you said something that for me helps better define, especially for our audience, what house hacking is. And your comment was generating income that I don't have to put out time and energy for, right?
Yep.
Passively. Okay, so I totally get that. I totally get that. As my buddy Dave would say, moving on.
Okay. All right. Great. And
But
so,
all jokes aside, man, that's a great analogy, right? It's generating income that you're not having to work for. And so I heard that. I believe I heard that correctly. And it makes a lot of sense, right? It's a very easy interpretation, especially for our audience out there. So please, man, continue. You're building us up to the fire pit stuff. So I'm on my edge of my seat now.
the big tribal relief at the end of the show. We'll
Exactly,
go into
exactly.
detail. Okay, great. So that was the first seed of passive investing and passive income in my interpretation of what that could be or might be or what have you. So from there, this is where I kind of fell short in the active space. I didn't have clarity around my goals and what I was actually trying to achieve long term. I was just super excited to be in real estate, to be able to do this at a time that, as we all know, that term in the market cycle, 2009 in the fall, was a depressed period in real estate. So it was a little easier for me to gain access to deals and whatnot. And so here's what I did. I mentioned my job I didn't like it. I didn't make much money. And I said, okay, if I'm going to get serious about real estate, it's going to take some capital. At least that was my interpretation of it. So I said, I've got to start making more money. I have to find a way. I was running all these little side businesses and audio rental and clothing line. And I was trying a bunch of stuff that failed
Right.
and post college ideas. And it was awful. But what I came across was this. I went to a job fair out in Colorado, and the oil industry at the time was just kicking up. It was booming. I interviewed with a bunch of companies and I got offered grunt work at an oil company, an oil services company. It was 14-hour days. It was working away from home. It was working out of state. And I ended up actually working in the Middle East overseas. It was a full-time commitment, 100-hour work weeks, 98 to be specific. And yes, it gave me some money to work with as I was being extremely frugal and living way below my means. I was putting 100% of my savings into real estate. And that led me to do some flips and some vacation rentals and some other strategies in the single family active space. By 2015, I was completely burned out. I was trying to scale this portfolio up naively, thinking, hey, one day I'm going to have like 100 single family homes. That's my goal, without really considering what that would look like. Every property I acquired was just that much more of a time commitment, to your point earlier. And on top of a 100-hour week, it just wasn't sustainable. It wasn't a workable model. I would either have to do away with the career or switch my investment model. So the light was closing in. I started surrounding myself with real estate groups, real estate mentors, coaches, podcasts, books, all kinds of resources in 2015. I read 52 books that year. It was crazy. I decided, okay, I want to be in real estate. I like the cash flow, the tax advantages, the appreciation, the leverage, everything that we know and love about it. But I do not want to be in the business myself of flipping and vacation rental and managing tenants and all this stuff. So I discovered private placements. I discovered real estate private placements, syndications as a layman's term, and the idea that I could leverage people that were doing this very well as operators, that had great broker relationships, they had connections, they could find deals, they could structure this, they had a passion for it. It was their full-time focus. And for me, I could be completely passive. I could be a limited partner and I could just say, here's 50K, share with me some of those profits and cash flow. And that became the solution for me. Not right for everyone, but this took a lot of self-awareness, a lot of self-education, and a lot of time, quite frankly, to get to this point. But from 2015 through today, I'm a full-time passive investor, and that's what I mean more specifically as I invest in apartment buildings and syndications as a limited partner. That's about 80% of what I do. I'm a cash flow focused investor.
Okay, cool. I appreciate that. So let me ask you a couple of questions. Okay, we're going to unpack this
Yeah.
because there's one of the things that when I get into these conversations, and I just posted a couple of podcasts my staff did where we talk through different vantage points, right? Because in real estate, one of the cool things about real estate is there's no exact way. And I think once
Right.
you start to pigeonhole yourself in this business, you naturally
Yep.
literally eliminate 80% of the opportunities out there, right? Literally.
Yeah.
So I appreciate the commentary earlier about you investing passively. So talk a little bit about your experiences, some of the challenges that you ran into, okay, that
Hmm.
led you into having a greater appreciation for investing passively. And here's why I asked that, right? You brought up self-awareness, which I can really appreciate. Self-awareness is a big deal because sometimes you may recognize that, hey, you love being an operator. Okay. And the flip side of that, you may recognize that, you know what, that's really not what I want to do. And now I want to spend my time. I'd rather be doing something else. And I don't enjoy that side of the business. Consequently, I'd rather put my money into something and generate a return. Right now, I share this because my very first partner, technically my second partner, was my CPA. And this was,
Okay.
I think, 12 years ago, okay, was my CPA. And so the reason why he wanted to invest in me, or literally invest in me, with me, is he had a fairly large firm in the county that we live in, right? In North County, San
Mhm.
Diego, very large CPA accounting firm. And he's been in that market, I think probably that business now for maybe 20, 25 years, getting ready to wind down with his wife.
Yeah.
But he said, hey, John, look, I love what I do. And I spent a lot of time building up this practice. So I don't want to leave what I'm doing.
Hmm.
But I do understand the value of real estate and I'm willing to put money alongside of you. And I said, okay, great. And we've done really well, very well together over the years. But he gave a really specific and clear purpose, right? In other words, hey, I'm a professional. I'm good at what I do. I love what I do. And even if I didn't like it, I've been doing it now for 25 years. I built out a practice with thousands of clients. And so, no, I'm not going to transition out. However, I understand the value of real estate, its benefits, and I'm willing to make an investment alongside of you because I believe that you can help me grow my wealth, right? So, talk a little bit about that.
100%. I'm glad you brought up that story. That's amazing because at the end of the day, what is a limited partner or a passive investor really doing? They're placing bets on people. They're placing bets on teams, on general partners to say either A, I like working with you. I like your philosophy. I like your work ethic. I like your track record, whatever it is. And I'm going to place a bet that you can go pull off a business plan on my behalf. And I'm willing to share that risk and share in those profits with you. And that's 100% what the game is. And why self awareness is so important to understand about yourself is that some folks believe they can do it best. And rightfully so. Maybe they can. They have the connections, they have the skill set. They're a handyman, a handy woman. They have partners and people in their network that can help them along the way. For those folks, it may make a tremendous amount of sense to be active, right? Or to be a general partner or to syndicate your own deals, perhaps. For me, what your question that you asked me earlier, kind of what were those, light bulb moments, so to speak. You know, Let me give you a story. I was flipping, I think it was my second house, single family home. It was out in Brighton, Colorado. First of all, I was trying to save money and be frugal, and I pulled in but my own mother to help me out with cleaning this place up. And I remember her yelling down the stairs. She says, "Travis, send me the electric drill." I didn't have one. I didn't even own an electric drill. And here I am thinking, I'm going to fix and flip a house. Why? Did it make any sense? I'm so not handy, by the way. I can paint a wall and I can sweep a floor. That's about my skills. And, it was, it was just those humiliating moments in life like that just made me realize, what the hell am I doing? And sometimes it takes jumping into something like that to understand it. Because if you had asked me pre-hand, do you think you're going to be good at this? I would have said, oh, yeah, I'm going to be really good at this. And then realizing some of the profits I turned from 3 to 6 months of work were just not worth it. It was not worth my time. And that's a thing too, active, investors of any sort. realize how much of a time commitment it can really become, because I was quite naive about that. And I didn't have the time to spare anyway. And it just became a monster as I started
Okay.
trying to scale that
So
up.
let's talk about that, right? When you talk about time commitment, and I was naive to how much time and energy it takes
Yeah.
to actually be able to execute on an investment successfully and produce a result, right? In this case, the result is the projections that we're using inside of our business plan, right? So
Hmm.
talk a little bit about that, because I think that's a very important point. So when you say, I didn't realize how much time it took,
Hmm.
talk about that.
Yeah. Yeah. Another short story of a house I was remodeling. So the idea on this one, I was going to rehab it, which it needed quite a bit of work, which I did mostly myself with friends, family, and I had to contract a few things out. Then I rented it out to a tenant that moved in and basically destroyed the house over the course of 12 months. Delayed rent, missed rent, skipped rent. They ended up bailing. It was a bad situation. I'd put in a ton of work and time up front. I'd put in a ton of time trying to self manage and deal with those problems as they came up. And then when they moved out, I had a whole lot more of a time commitment on my hands again to turn the property. And on that particular one, I just ended up selling. And so it had been like a year and let's say a month, give or take. And what profit I made was roughly 10%. I made a 10% profit, all things considered, the realtor commissions, the money I had put into the deal. And to think in retrospect that nowadays I have passive deals that I invest in, not naming any particular offerings or investment firms, but I can get sometimes a 10% annualized return by doing absolutely nothing, just being a limited partner, just saying here's 100K and then getting 10K
All
in
right. So
return.
I'm going to challenge what you said a little bit.
Sure.
Okay.
Yeah.
Because there's really no such thing as doing nothing for an investment, right?
Right.
I'll give you an
Correct.
example. All right. So I understand when you say, hey, I have made an investment in this real estate that's being operated by company X. Okay.
Okay.
But you have to realize that it took you a lot of hours
Yep.
to be able to build up that cash that
Hmm.
you created to then place into another investment, right?
Yeah.
It took you tons of time for most people. Okay. It's
Yeah.
going to take them some time to be able to build up some cash to now have to place in another investment. Okay. So the reason why I wanted to bring that up and talk a little
Hmm.
bit about that is because there's no free in investment.
Nope.
There are only alternatives, right? And
Right.
how you need to maneuver your time to be able to place your money in something that's going to get a return on, in this case, not only your money, but also on your time, right? Because
Yes.
even though, like to your point, you're like, hey, John, I made this investment and I'm doing nothing for it right now. You're right. You're not working actively to produce that result like the
Correct.
operator is, but you spent a lot of time working, building cash to be able to make that investment. Okay. I just wanted to clarify that. I just
Yes.
wanted
Thank
to
you.
clarify that because there's no free, right? There's
Yep.
no free. Every investment has its equivalent risk.
Yep.
And it becomes even more so when you start understanding that, hey, man, I really spent a lot of time building up this cash. I might want to be smart about how I invest
Right.
it. Okay.
Great transition point. So Theo Hicks and I launched a show recently called the Actively Passive Show. So the irony in being the passive investor is that it is somewhat active. And that's what the show is really about. Our themes and our topics are around both active and passive, and to display, to your point, in more detail what that looks like. So yes, I mentioned 2015, how that was a huge self education year, 52 books, podcasts, mentors, coaching. I had a lot that happened that year. That was a lot of time commitment. So I'm not discrediting that I didn't go through that process, and I did. And for a lot of folks, that's a longer process. And for me, it's an ongoing process. So I'm naturally interested in financial news and investing in real estate. And I do a lot of self study because I like to. It could be a Saturday or Sunday. I'm watching a documentary on the history of single family homes. That's just me. Now, so that does take some time. It's not necessary in all cases, but I put a lot of self education time in. In addition, to your point, you have to know how to vet a sponsor. You have to know how to vet a deal. You have to know how to vet a market. And how do you know how to do that? Well, mentors, coaching, podcast, books, self-education. So there is definitely a level of that. And to do a deal, I mean, of course, there's asking your questions, meeting the general partners, watching webinars, signing docs, getting verification, accreditation letters. I mean, there's an active side to it. But mostly, I want to point out, it is a front-loaded model. Once you establish your philosophy in investing, once you establish your criteria for the most part, once you know a bunch of general partners that you enjoy working with, that was the front load of the model. From here, at least in my case, then I just mostly continue investing with the same groups. I know how to look at those deals. I know how to vet them. I already know the operators. So it is mostly a passive journey from that point. But yes, anytime I go to work with a new operator, anytime I say, hey, maybe I want to invest in a mobile home park deal, I don't know anything about a mobile home park deal. So there's going to be some education that's required up front to your point.
So I appreciate you saying that, right? I mean, I'm never going to be the person on my show where I endorse someone just blindly make an investment into whatever the investment opportunity is, right? Because I've learned over the years, there's really no such thing as a passive investment. I mean, you can get to a point where you understand something really well, right? Or you have a good enough understanding of that investment or that product type where you feel comfortable making an investment in it because you have a pretty good understanding of what the potential returns can look like, right? And what the risk is. I think that's just an important point for people to understand. The reality is it takes quite a bit of time for most people out there in the world to be able to earn income and then save it, right? Now that we talked about earning dollars and the time and energy that it requires and why it's important to be smart about that because you spent time earning that. So talk a little bit about now how to properly qualify an investment opportunity so that when you deploy your hard-earned money, you're able to create more success, okay, and not lose those dollars.
100%. Yes. On the top of everybody's mind, active or passive, should be preservation of capital. Like Warren Buffett always points out, don't lose money. Rule number one, right? So here's my opinion on this. You should really start with the self-education piece. Try to get a vast overview of what options are out there, what that means, how they function, talking about stocks, bonds, mutual funds, REITs, ETFs, private placements, just kind of a general sense of kind of what's out there and what you could do. Usually in that process, something stands out to where you think, that makes a lot of sense. That kind of clicks for me, or I like that. For me, that was real estate. For others, that's stocks, or it's day trading, or it's flipping houses. It's whatever it is. Okay.
Right.
So that's the best advice I can give right there is start with your self-education and identify what works for you. Now, why do I say that? Well, the more you know about something, the lower your risk can potentially go down.
I agree
because
with that.
You understand the ins and outs and you've talked to a lot of people and you've looked at a lot of deals and you kind of get it. So moving forward, I did a lot of back testing on multifamily, specifically B and C class value add multifamily.
What does that mean, Travis? Back testing?
Yeah, let me explain it. A lot of research, stats and facts, Harvard studies, looking at past recessions, what happened to multifamily in 2008 and 2009. I knew what happened to single family because I was buying it in 2009. I got to see that firsthand. All my family owned single family. I got all their stories. But how did a 400 unit 1985 property hold up with a 95% occupancy going in Dallas, Texas, for example? I did a lot of research. Just to make it simple, I did a lot of research. Sure. Now, in addition to the research, I sought out people who went through that downturn. I sought out mentors that were in their 60s and 70s that have been doing this private placement game for 20 to 30 years. And I asked about their portfolios. I asked about their stocks. I asked about single family if they owned it. I asked about multifamily. And so all of this gave me personally the courage or the confidence to begin moving forward. I didn't know I was going to go full force into it. I didn't know I was going to be kind of where I am today and doing what I was going to do, but I was willing to take a chance on it. So those were some of the first steps that I took. in doing that. Now, your question was, how do you go about vetting an operator or a deal? Is that right?
Yeah, a deal.
Yeah. So there's some specific books out there that go over the very much the raw data and the how to of underwriting deals and acquisitions and things like this. I've read some of those. I've taken some courses. Again, self-education is first, right? And from there, I built my own criteria. And I said to myself things like, I like properties built in the 80s, 90s, and early 2000s. I like average rents around, let's call it $1,000 a month, where a lot of people can afford that. I like a value add plan that we go in and we fix things up and we can potentially push rents. But even if we can't, it's still a cash flowing asset out of the gate as it stands. So I bring down my risk level a little bit by doing that. Criteria on the team executing the deal. What's their experience? What do those numbers look like? Is this something that they do over and over again? Is this an experiment that they're trying for the first time? Point is, I built a criteria list, and it's probably no more than one page, and it's just a bunch of check boxes, and I just made it on my computer, and that came from all the books and things I had read and mentors I had had. And so I go about vetting a deal, quote unquote, by checking off those boxes. And if I'm looking at a deal that's not checking those boxes and not meeting my criteria, I don't invest in that deal. And that's how I try to limit my risk as a limited partner. Deferring to the resources and books out there that can help you, get into the exact how-to, which is where I started with it.
Okay, cool. So, I appreciate the high level summary. If you could boil maybe one or two things down
Sure.
when you are considering an investment,
Yeah.
what would your number one be and say your top three?
Okay, sure. I'll just go over three in a typical multifamily value add syndication project. Okay.
Right.
Let's say it's going to be a 5-year plan. The operator plans to go in, renovate, push rents, and sell within 5 years. Okay. I'm going to look at the debt that they're putting on the project. And what I like personally is agency debt. Okay. Fannie and Freddie. I like 10-year terms on a 5-year business plan as an example. And by the way, all this doesn't have to be black and white. This is just in general. This is some of my criteria. And why do I like 10-year term? Well, let's say in 5 years, even though we had full intentions and optimism of selling at a great price point, what if we're in the next Great Depression or a recession and that equity isn't there? Well, I don't want to be forced into having to sell at a loss or have to refinance when there's no liquidity to do so, like we experienced in some parts of '08 and 2009. So that gives us a 5-year buffer to keep going beyond and say, at least we got something that's cash flowing. Maybe we can just hold on to it for 2 or 3 years. Hopefully the economy recovers and then we'll figure it out. That gives us an option, right? It's a little safety net. I like to look at break-even occupancy on a project. So say we have a 100-unit deal and the break-even occupancy is 70%. We can have 30 vacant units / 30 units in total where we're not collecting any kind of revenue. Tenants aren't paying, they're vacant, and we can still break even. And that was a hard lesson learned with single family, is where you have one tenant and it's either you're 100% occupied or 100% vacant. And when you're 100% vacant, it's pretty bad because you still have a lot of bills and obligations on top of that. It's not like you break even. It's like you're underwater. And so that was a hard thing to learn. The other thing I look at, let's see, we talked about break even, the debt terms on the project. Let's just go with the operator itself. And again, I like to work with operators that do the same thing over and over and over again, and they specialize in a particular niche. To me, that lessens risk. There's plenty of operators that have their hands in all kinds of stuff, which is fine. I'm not bashing that. But
what do you mean by that when you say there are plenty of operators who have their hands in?
There's operators, let's say they have a philosophy of, we invest in cash flow real estate. Well, they might have a little bit of office, a little bit of retail, a little bit of self-storage, maybe a mobile home park, maybe a multifamily, maybe a little bit of single family, maybe a little debt lending. There's a lot of different models. And the odds that they're going to be experts in every single one of those is quite rare. And so I would prefer to work with an operator that says, all we do and all we've ever done for the most part is this right here. We do B class value add 5-year plan, 200 to 300 unit, properties. So again, what I'm saying right now, Doesn't have to be right for anybody else out there. This is
I
part
get
of
it. I get
my
it. Yeah.
criteria. I'm
No,
just
and
sharing that.
I appreciate you sharing that. I appreciate you sharing.
Yeah, yeah. One other thing you could look at, by the way, just to give you a fourth, I guess, is the interest rate. Is it fixed? Is it variable? If it's variable, are they purchasing a rate cap where there's kind of a maximum of that interest rate could go up to? It's almost like an insurance policy. So again, you're just looking for ways to, is the operator being conservative? One more, it just came to mind. How about your cap rate going in versus your exit cap rate or reversion cap rate going out? I would like to see on the underwriting on a 5-year business plan that say we're buying at a 5 cap, we're exiting potentially at a 5.5 to a 6 cap. Now, we obviously don't want that to happen. That means a softening market. That means a lower purchase price. But if I'm looking at the projections and I'm knowing that the operator is being conservative, I would be more willing to do a deal like that and partner in it. So these are just examples of pieces of criteria you can develop for yourself through educating yourself through books and mentors and podcasts like this.
Okay, good, good. I really appreciate that. Okay, so share one of your greatest success stories, okay, as a passive investor and what that looked like. Now, you're not as close to the deal as an operator would be,
Right.
okay, but you still have your interpretation of what success looked like on your best deal, right? So talk a little bit about that, and then we're going to wrap it up with the deal that didn't work out so well and what
Yep.
you learned from that.
Yep. 100%. Two quick stories on both if you want, but two that just came to mind. As a passive investor, a limited partner, we went into a deal out in Arizona. I forget the exact unit count, say a 400 unit value add plan. We thought, hey, we're going to hold this 5 to 7 years potentially. This deal happened several years ago. But what happened is we got about 12 months in and we got an off market offer that was quite high. And the GP just decided, hey, we should take it because this can give the limited partners almost a 40% IRR in about 18 months compared to holding this for like an 8% cash flow for the next 5 years. So they decided, that was not in my control, that they were going to execute on that option. Pros and cons, I really thought I was going to have some cash flow for 5 to 7 years. It turned out I didn't. It was 18 months. But we ended up with a nice return that I could then go put into 2 other deals, is what I did with it. So to me, that was a realistic home run in my book, right?
Awesome.
Very little effort on my part.
Really, really good example, actually.
Real quick on the single family, I had just right time, right market, call it what you will, dumb luck, but I bought a bank owned property for about $97,000. This was like in 2012 out in Colorado. And I put a tenant in it for about a year and a half, give or take, and ended up selling it for $215. And I didn't do a thing to it. I didn't even paint the walls. I didn't do the carpet. I did nothing. I think I changed out maybe a washer machine or something. And so that was a home run on the active side,
sure,
on the single family space. Now to get into bad deals, 2 things. One of my first deals that I partnered with as a passive investor, I failed to properly vet out the sponsorship team. They had great intentions and I like them very much as people, but from a business standpoint, they didn't know what they were doing. And so we got into a deal that was in over their heads. They made a lot of bad decisions. Ultimately, they stopped the value add process because of all the things that were happening. And they decided, at the end of the day, we bought at a good price and we bought in a good market, thank goodness. And there's some equity there. Let's just sell it early and get out of it. And that's what we did. And so we got below what we were expecting as far as returns, but we were profitable. So I can't complain too much over it.
So they had a value add plan. They didn't execute on the plan. Talk about the mistakes that were made, right? At least from your vantage point, from your viewpoint.
Yeah, the first amateur mistake they made was they bought a pre-existing LLC that owned the property and they didn't form a new one to take over the property. And what had happened was there was litigation that they weren't aware of, that because the owner was that LLC in the past, we were now responsible for what came up on the property in the past. And so there were some lawsuits that happened against the property management company and against the GPs. It was kind of a mess there. They stopped distributions early because they didn't know what to do. And they thought that would be at least being conservative, which maybe that was the right call. But again, we were all kind of expecting our distributions to come in and they didn't. They hired some bad contracting firms that, yeah, they were kind of shady. They hired the wrong property management company, which again turned out to be a lawsuit situation. And so it was just like one thing after the next. Every time I
Who
talked,
sued who? Who sued who? Did they sue the property management company, or did the property management
the
company sue them?
the property management company sued them because of the contract that they had. And I don't know all the inner workings of it, but basically they were supposed to be the property manager for X amount of time or years or whatever. And all of a sudden the GP is telling them, you're out tomorrow. We don't want you at all. And it was a counter lawsuit too, because they had taken some bad debt and recategorized it. It was just a mess, man. It just on and on and on and on again. So there are risks in this stuff, and a lot comes from the competency of the general partners and the experience level of knowing how to handle things that might pop up, maybe a flood, a hurricane, a fire, a lawsuit, frivolous lawsuit. Just
Right.
kind of having someone to reach out to at the very least would be nice to know.
So if you could do that deal over again, the one that had the mountain of problems,
yes.
How would you have approached that deal differently? Just for our audience, right? Give them some context.
Yeah. So here was my process on vetting the operator, why it was a bad process. Met face to face. They told me about their 25 plus years in real estate. Zero had been in the syndication space. I didn't even ask that. I just took it for face value. Wow, you've been doing this 25 years. Okay. Very optimistic, very salesy. Again, good people, family people, but at the end of the day, hadn't done this before. That was the problem. I didn't do a background check. I didn't ask specific questions about how many times have you done this, or show me your track record, which clearly would have been nothing. Unprofessional red flags that popped up right away. They were hard mailing docs to be signed over FedEx, and a lot of inefficiencies that just didn't make a lot of sense. It's not that you can't do that or that's fraudulent. It's just, why not pay $50 a month and use DocuSign? Why are you making this difficult and paying thousands of dollars shipping everybody these overnight FedEx things? And just unprofessional.
Right.
So I just wish I had asked more questions at the end of the day. Just ask a lot of questions and get a good gut check for the business side of it, not just the personal side.
I think that's really the biggest lesson, right? Is based on what you described, is learning what questions to ask. So, when we started this and we started talking about the various experiences that you had, and I said, okay, well, nothing is free, right? When it comes to investing, you have to do two things, usually three. Okay. It's a function of mindset, right? Your skill set. So you have to build your mindset. You have to build a skill set. Okay. And you have to take action. It's those three things. You know how everyone's always asking for a secret? That's the secret formula. That's it.
I would agree.
And you can use that formula for anything, right? For investing, for sports, for academics. It doesn't matter, for work. You need those three things and to be able to produce above average result. Now, let's talk about what you said. Your comment was, okay, well, the biggest thing that I learned was to ask better questions. And that's why knowing a little bit about what you're getting ready to do is so important, because it helps you know what questions to ask, right? You don't have to be an expert at that topic. You really don't, but you have to know enough about it to be able to ask intelligent questions, right? Especially to be able to vet people out. Because if you cannot figure out what questions to ask to know if someone is remotely either telling the truth or not, it's going to translate into more problems. So one of the examples that you gave were the operators that you spoke about, right? Where they ran into a mountain of problems, right? Everything just started compounding. That's a function of not knowing what questions to ask. I bet you if you broke that down, the lack of experiences comes down to, I don't have the experiences to know what questions to ask to prevent me from getting into problems, right? It's the same thing on the investing side, right? It's the exact same thing. So knowing what questions to ask just positions us for better success or long-term success and better opportunity. So
I would agree with that.
I really appreciate you sharing that. So, hey man, we're getting ready to wind down our show. I really want to thank you, Travis. This was really a kind of a cool conversation. We touched on a couple different things that I think are really, really valuable. So I think one of the big things is you got an opportunity to share your perspective, or at least from your viewpoint, how you transitioned into this space, We then talked about investing passively, but one of the key takeaways there is nothing's free, right?
Yep.
Okay. If you want a great result, you're just going to have to put more time and energy into producing that, even if it's passively, right? If you're not staying on top of your investments, okay, usually those investments tend to soften over the course of years when you're not actively monitoring them, right? Just like an investment, if you're an operator, you're lax on your investments, you're not actually actively operating that investment, it just loses momentum, right? You don't outperform. In fact, it's almost impossible to outperform. So we talked a little bit about that, but then you brought up some great topics, and that was, you shared some lessons learned through stories on things that you can actually do to allow yourself to become more successful investing passively. And one of those big things, one of those key takeaways was to put yourself in a position where you learn enough. You don't have to be the expert, but you learn enough to be able to qualify people with intelligent questions, right? Know what questions to ask, ultimately to be able to make wiser decisions. Because in this world, in the world of money, I can pretty much say that, the results that you create in this business, they probably run fairly parallel to your ability to make decisions, right? And that's just the reality of investing, whether it be in real estate or the other opportunities. So, man, what a great conversation. I want to thank you, Travis. What questions do you have for me, but that you think it adds some value to our audience? And then we're going to, I'm going to ask you to share how people can get a hold of you.
Yeah, 100%. Just real quick, just to piggyback on what you were saying. Here's an example of a question you might ask from a limited partner standpoint to the general partnership, where there may not be a right or a wrong answer. What I'm looking for is confidence that it's been thought through. Okay.
That's a good one.
Would be a question to the extent of, and we'll relate it to modern times here. What if interest rates double? What if we have a huge recession that's exactly like 2008 and 2009? No one knows the answer. That's the truth. No one knows the answer. But you can have a response to those questions, and you could have thought these through. You could have done a stress test on the property to say, here's all the just factors and situations that could potentially unfold. And this is what that result would look like on paper. And just to know that the team has thought that through and not to go, that's kind of the red flag right there, right? You're just looking for the competency in the team. So just to give you a practical.
Yeah, no, that's a really good one, man. Actually, that's I think a great share. Really good.
You asked how to reach me, a lot of ways. So I give back some time, 15-minute free Q&A calls, anything we've talked about here today, anything I blog about or video post. You can get that at www.ashcroftcapital.com/connect with Travis. And on that same page, I have a downloadable PDF. It's free, and it's to the point, more specifically, your questions today on what questions to ask a general partner, how to vet a deal, how to vet a market, industry terminology. The title of that download is called Understanding Real Estate Private Placements. And with the help of our attorneys over at Ashcroft, we've been able to create that resource. So all of that stuff is free. There's no upsell to any of it. Just happy to help where I can and if I can. So thanks so much.
Awesome, man. Really appreciate having you on. And I want to wish you continued success, bud.
Thank you so much, John.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.